We have Sumeet Kariwala, India Banks analyst at Morgan Stanley, joining in. Sumit, good afternoon and welcome to the show, and a pleasure to speak to you as always. As Harsh was just indicating right now, with the way banks have fared in the fourth quarter, the key is going to be as to what FY26 is expected to look like from here on. What is your assessment, and how strong are you expecting the banks to contribute to the earnings growth?
Thanks, Hiral. Thanks, Harsh, and good to be on the show. From a fiscal 26 perspective, I think so. We've been cutting earnings after the fourth quarter, and we have highlighted in our reports that there is some downside risk yet. In terms of loan growth, the outlook is pretty muted. There will be some revival of retail demand given the rate cuts and income tax rate cuts in the budget. But corporate is still very muted. As interest rates come down, there'll be disintermediation by the mod markets. So that will weigh slightly on loan growth. MSME will consolidate. So I think over the next 2-3 quarters, loan growth will be in a tight band, 10 to 11%, and pick up thereafter. Margins, last quarter was okay. If I adjust for the year-end impact, the margins were slightly better than what we thought. But the full impact of repo rate cut will play out in June and September. So over the next 2 quarters, this quarter and the next quarter, you'll see margin decline in the range of 15 to 25 bips, depending on the bank we're talking about. And part of this decline is more about normalization, because what happens with banks is when interest rates move up, the benefit on the spread is positive. When interest rates move down, the low-cost deposits don't reprice lower, and to that extent, there's a net negative impact. There's lead lag, but the net impact is negative. So what you're going to see is fiscal 26 growth is muted, margins come off, and move towards normalization. Fiscal 27 and 28 is when you see a meaningful rebound.
Right, Sumit, always a pleasure speaking to you. I want to unpack this a little bit more. Let me first ask you that outperformance that you were expecting in private sector banks, has that fully played out, or is there more to go?
No, I think so. The outperformance that we've been talking about, Harsh, and we did talk about that last year as well.
Yes.
That will continue, is what I believe. And the reason for that is the challenge with respect to profitability in the current cycle. If I look at 2010 to 20, it was all about asset quality. Any bank that had a clean balance sheet could have grown loans faster than the system, gained market share, and therefore re-rate further. This cycle, the big challenge is profitability, and there are a number of factors driving that. And if I look at which banks are better placed in that context, it's the large private banks in our view. And what is going to happen is, as the low-hanging fruits get plugged, the asset quality situation remains benign and normalizes. The large private banks will be able to outperform on earnings, and therefore the relative valuation gap that you see right now will expand further in our view.
How do you view the PSU banking pack as a whole, without taking names here, Sumit? You believe that these are fair valuations at this point?
Sorry, I got you.
Okay. Not sure. Maybe we have Sumit on a bad line. Let's ask the back end. Producers, not sure, while you all patch him. But Hiral, frankly, what he's saying clearly is that the outperformance in private sector banks will likely continue. Sumit, hope you can hear me now, loud and clear.
Yeah, I can hear you now.
Hi.
Yeah,
So
I can hear you now.
Sumit, how do you view the PSU banking pack in terms of valuations? Do you believe that they're fully priced, well priced in terms of risk adjusted, as well as in terms of growth, the way it's playing out, at least at this point?
Yeah, I think so. State-owned banks have re-rated quite meaningfully over the last 4 or 5 years. And they won't see asset quality issues. But I think so profitability normalization for them will be somewhat sharper than the large private banks. And the reason why I say so is twofold. Over the last 3-4 years, if I look at their margin progression, they have not really gained an advantage despite interest rates moving higher, despite the share of unsecured loan mix moving up, despite the share of NPLs moving down. So that is going to be a problem as you get into a rate cut cycle. The second challenge is that if you dissect the ROA, roughly 30-35% of the ROA is driven by recoveries from old NPLs and elevated treasury gains. That would normalize over the next 2 years. So I think fiscal 26 is okay. Fiscal 27 is when we expect recoveries from return of accounts to come off sharply, and that's when the pressure on state-owned banks will increase, is what we believe.
Something to look out for, Sumit. Sumit, let me take a wider question now with regard to what levers or what factors will drive outperformance and which banks, in your view, will outperform? Of course, you've already spoken about private sector banks, but talk to us about levers and what pocket will outperform.
Yeah, so I talked about normalization of margins. So if you look
Yes.
at the large private banks over the last 3 to 4 years, they have a starting point of margin which is much higher than what they operated historically. What that means is that even as the rate cycle turns and there are more interest rate cuts, the margin will normalize at a level which is higher than the peer banks, which I think so is a big starting point of advantage. The second is that they have ability to improve loan mix. Over the last 6 to 9 months, the unsecured loan growth has slowed down. There are a lot of segments where they have chosen not to grow. So if you look at a segment like mortgages, some of the large private banks are losing market share because they are choosing profitability over growth, is what we believe. So they have room for operating leverage. They have room for improving loan mix. And all of that would mean that they hold on to ROAs, which are much above historical levels. And that, to me, is a very big advantage. Very big advantage, which most of the sector is not going to have. And you'll see this play out over the next 2 years.
Interesting. Sumit, you know, it's a rate cutting cycle. And I have 2 questions on this. One, does credit growth come back significantly in FY26? If so, what is it that y'all are penciling in terms of growth? And second is with regard to margins. You suggested already, and correctly so, that margins, especially for the larger private sector banks, have surprised on the upside in Q4. Can they continue to do so? And is the margin reset, therefore, much better than you would have earlier anticipated?
Okay, loan growth, we are not expecting any sharp acceleration right now.
Sure.
There's some revival of demand that should expect in second half of fiscal 26 with respect to retail. MSME is already doing well. Large corporate is where the problem is. Growth trends have been muted, and I think there'll be increasing disintermediation by the bond markets where interest rates have come down quite meaningfully. So there will be a range-bound credit growth, and the pickup should most likely be a fiscal 27 event. In terms of margins, again, when you look at the extent of decline, you won't find a lot of disparity between banks. I would once again say that the starting point is what matters. Over the last 3-4 years, banks that have been able to capitalize on the higher interest rate cycle have ability to lose margins as the rate cycle moves lower. Not every bank has done that, and which is where the gap in terms of ROA will widen. Large private banks will move closer to sustainable ROA. Right now they are 10 to 15% higher, and as they move to sustainable ROAs, outperform peers who will move below sustainable ROAs, the valuation re-rating will actually continue.
Sumeet, on asset quality, the one key concern there seems to be you have personal loans, credit cards, which is in the unsecured basket, and you have some concern around microfinance. How quickly does that cycle play out, and how quickly do we revive from that?
Yeah, so Harsh, again, I'm not that worried about asset quality from a system perspective.
Sure.
If you look at the consumer unsecured, okay, it played out with respect to certain banks and certain pockets, but the overall system was fine, and I think even for those banks and those pockets, we are seeing signs of stabilization or improvement depending on the segment we are talking about. MFI, in my view, is a tough nut to crack. The extent of over-leveraging in that sector was much higher than consumer unsecured. You're still seeing some stage where collection efficiency is a lot more volatile than what you would want to. And the disbursement growth adjusted for repayments is still quite muted. So MFI, I do expect some level of stabilization over the next 2 quarters, given that almost 10 to 15% of the loan book has gone bad. But I would wait and watch on that one.
Sumit, a wait and watch. My last question coming to you is, let's not break this up between PSUs and the private banking space. Let's look at the large cap, private and PSUs. Where would your preference be? Would it be a large cap PSU bank or a large cap private bank? And within the smaller names, the mid cap names, would it be private banks or PSU banks?
Yeah, so I'll make that a bit more simple if you allow me to. We are very constructive on the large private banks, very, very constructive. Outside of that, it's more stock specific. So there are a few stocks that we like within the mid-sized banking space. We have some relative preference in the state-owned banking space, but the level of conviction within the sector is quite wide.
So Sumit, what would those smaller names be?
I don't want to talk about individual stocks, but the broader set is what I can talk about, which is large private over mid-sized banks over state-owned banks.
Right. All right. Thank you so much for sharing those views. So that is Sumeet Kariwala, India Banks analyst at Morgan Stanley, joining in as well.